Hey, welcome to the Presidio Perspective. We are so glad that you joined us here on the podcast. We got a great show for you today. We're talking about real estate. Are we in a bubble? It's hot, that market. We have taxes, a new proposal from Biden, and what's next for the market? Should we sell in May and go away? I'm ready. Luke, you look like you're ready now. Sierra, I know Sierra's ready.
I'm ready now. I thought something was different.
Let's get started with the show. Yes, get that disclaimer out. Keep our legal team and compliance team happy. Everyone's read that. All right, thanks. Got those disclosures out of the way. The compliance team, we did our job. Thanks. Got that. So, hey, welcome back, everyone. We are excited for today's episode. These things are just getting better and better, Luke, I tell you.
It's getting a little easier, although we're getting closer and closer every 2 weeks.
Yeah. I should get a breath mint before the show, I think. Yeah, this is good. So, hey, we got a lot to cover, so let's get into it. I wanted to lead off today's episode talking about the local residential real estate market. It's certainly the water cooler talk. You know, lots of people in my neighborhood are talking about real estate prices. Lots of transactions going. We've just touched on it before, but I think it's important. A lot of people still have 2008 and the Great Recession in their minds. And so, you know, when they see real estate prices going up and up and up, they wonder, am I getting priced out? You know, should I jump in? Am I going to jump in and buy the big house right before it goes over the edge? So I don't know. We should talk about it a little bit. I mean, San Diego, after all, was the #1 real estate market in the country last year. Mm-hmm. And that was before it really got going.
Right.
I mean, so far, year to date, it's nuts.
It is nuts.
And I mean, I'm sure you have stories. Many of you listening probably have stories. And I mean, what house prices are going for in neighborhoods all throughout the county and in Orange County as well are just reaching all-time highs. Prices that people thought this house will never achieve that kind of bid.
That's right.
And it's a lot of bids. You know, it's an efficient market.
It's a seller's market.
It is a seller's market.
Way, right?
Absolutely. Mm-hmm. So, I mean, one, are we in a bubble, right? We kind of want to address that. Mm-hmm. You know, can the market keep going higher? And what would cause this market to go lower? Because a lot of people are concerned about that.
So bubble, like define bubble. Maybe just start with that. What would you define a bubble in any asset class?
Yeah, I think when prices have reached valuations that are beyond reality.
Right. So
right?
And even
euphoria usually exists, right? That this is what has to happen, and you buy even though the economics suggests that it doesn't make sense.
There it is. So the economics, the underpinnings of that asset value are somewhat out of sync, such that euphoria has taken over.
Right.
Euphoria can exist in conjunction with firm economics and not create a bubble. So
that's good.
That could be where we're at today.
So let's just put it in context. For those of you who are watching this, you can look. We're going to look at San Diego real estate timeline, Sierra, and put that up because I think the Case-Shiller Index, which you can Google it, it's out there. You can look at your county, and this is the San Diego Home Price Index going back to 1980 something. And so we see these trend lines. I mean, we've seen some really big run up in the market before. I mean, if you're looking at the late 90s to the mid 2000s, I mean, that was the last time that we had a real estate bubble. And you had this massive correction in this bear market during a recession in 2008 to 2009, and it took a long time for home prices to recover. But look how long it took to recover. I mean, we just hit, prices that we saw in San Diego back in 2005 just a couple years ago, right, in 2018. And so here we are approaching new highs, but man, it has been 13 years since that downturn. So reaching new highs shouldn't be all that concerning with everything that's gone on. I mean, if we plot a line of the stock market on here, it's reached way higher than local real estate.
That's right. It almost looks like NASDAQ, 2002, I think it broke out in 15 years later.
Right. So, I mean, when we look at this trend line, we see a pretty stable growth rate leading up into this year. And I think that yellow portion at the very end is kind of hypothetical, right, of kind of where the trend line is going. Mm-hmm. But, we didn't see this big ramp up to get to where we are today. It's been pretty slow, stable, methodical. Actually, Luke, you pulled a chart. I think this is national, but if you want to go to the real estate year over year, And Luke, you can talk to this a little bit because this kind of highlights what I was just saying, right?
Well, it's just a big, crazy, wavy line. No, if you look at
This doesn't say anything.
If you look at it, what it says is that as of the most recent monthly data, you have double-digit growth year over year for house prices.
Yeah.
And usually the reference point for housing is that people go back to 2008, the last housing bubble, so what you were just referring to. And if you look back to that time frame from 2002 to 2005, you had double-digit growth every month.
Yeah.
For 3-4 years in a row.
Right.
So that tends to have a much bigger change of what's going on just right now.
Yeah. So here we are preaching double-digit growth. I mean, really something that we haven't seen in a long time. Mm-hmm. And so, if this can continue, again, we've talked about this show before, it's maybe easier to start to see the beginnings of a bubble versus the end. But, for those who are saying, hey, this real estate market is in bubble territory, I think we're debunking that myth right now.
Right. And I think a bubble would suggest that something has to pop, that something has to go down. And, one of the things that I hear you talk about a lot is inflation, acquiring real estate. You're effectively paying it off for 30 years, which means you're paying it off with inflated dollars.
That aren't worth much.
Right.
Yeah.
And that concept has actually really enlightened me on what actually real estate means in your whole financial plan. Not why do you just buy it and try to make money with it, but how does it fit in a 30-year plan? Mm-hmm. And in the case of are we in a bubble or not, well, it becomes a lot less relevant if you're thinking about paying it off with inflated dollars over the next 30 years.
Yeah, absolutely. And so I think that's where we get to the economics part of the discussion, right?
Sure.
Because interest rates are very low, making housing very affordable. Mm-hmm. And let's go back to 2008, okay? Mm-hmm. Let's just do this exercise because that's what's in everybody's mind when they talk about a bubble. Mm-hmm. And what we had was a very different scenario than what we're seeing now. Mm-hmm. And I've talked about this many, many times, but we all know, hopefully at this point, what was causing that recession was really, we had Gen X, which was a smaller generation than the baby boom generation. Mm-hmm. And so when you have a smaller generation inheriting all the property, buying all the property as they move up to the next level, there wasn't enough buyers to do that. Real estate's going to go down, economics go down. So here's the idea. We're going to just to fill the gap, we're going to take this portion of folks that would otherwise be renters and we're going to make them buyers, right? So if you had a bad credit score, if you didn't make a lot of money, if you didn't pay your bills, if you didn't have a job, if you didn't have a down payment, there was a solution for all those. In fact, at the peak of the disasters was the option arm loans, where if you can't make your principal, there's interest only. Hey, if you can't pay the interest, no problem. Just pay a little bit of the interest. We'll tack it on the back end. Mm-hmm. I mean, and I was in college in the early 2000s, and I mean, I had friends in college that didn't have a job, but they had taken out a credit card, so they had a credit score, and they were buying multiple houses, right? Because they could get a loan, 100% financed, like don't make any payments. I mean, these were college kids that we gave keys to houses to. And so obviously that was what was going on behind the scenes of this bubble, right? The economics weren't there. They couldn't afford the houses. That's not what we're seeing today.
It's remarkably different than today, and what you've seen is a step function change in real estate. And really that's what you see in these charts that we just talked. All of a sudden you had very normalized growth that has now hit double digit. You've had a huge step change as rates went from, 4%?
Yeah, I mean, just think if you're a family that's renting and say you're $3,500 for your rent, okay, and you're paying $3,500 a month, that affords about a $900,000 mortgage. So that family with loans as they are today are looking in the $1 million price range and kind of being a break even on what they're paying in rent. Not to mention some of that money is going to pay down principal. And so, so here we are, U.S. consumer as strong as it's ever been. Savings rate is as high as it's ever been. Economy's rebounding. We're getting back to this, excellent employment number. So especially here in Southern California, the folks that are buying houses, they're very strong buyers. They're not stretching themselves too much to get into this next house, which is supporting why there's 32 bids, right, on this home that's going for an all-time high price.
Right. And
so, go ahead.
Well, and so that goes back to the seller's market. And, we can go through anecdotes, right? We've talked to individuals about certain scenarios that seem like they're frothy or whatnot, but really what you just talked about, that people are not stretching
Yeah.
to buy.
Right.
That there's lots of affordability. It really underpins that there is a lot of secure fundamentals in the market. And so let's just consider, I'll play devil's advocate for a second. Let's consider what is that black swan event that creates this scenario that people are so fearful of.
Yeah, it was interesting. As I was sharing with you earlier, I was talking to a major real estate investor yesterday, and they were hypothesizing, once interest rates go back up, you can see the market, coming down. And that, perhaps the Fed isn't going to do that anytime soon. So, yeah, I agree with a lot of that. So let's say interest rates go up to 5%. All these people who just bought homes, likely the vast majority of them are getting 30-year fixed mortgages in the twos. Right. It's not going to affect them.
Right.
They're going to continue to pay. In fact, if interest rates reach 5%, we know we've had inflation, so it's just even more affordable for them to pay that fixed mortgage payment with deflated dollars, right?
Right.
So you don't create a housing crash. Now, what could that mean? Yeah, we're not going to continue to fetch the higher and higher bids.
Right. So maybe prices in that scenario, prices don't continue to have this double-digit clip like they did back at the previous housing bubble.
Stall out. Yeah, Sierra, I know you're out here filming, but I need you back on the ones and twos. Can you pull back the San Diego real estate timeline real quick? Are you able to zoom in at all on the right side of this graph? Don't worry about it. It's all right. So right there on the right side in 2018, we're going to see, I'll just explain it for those listening to the show. In 2018, we have this fast growth real estate market from 2010 until now. And you look in 2018 and there's a flat line. You see that right on the right side? So that flat line, what happened? Interest rates ran up on mortgages. Mortgages were at 4.75 at that time. There it is.
Yeah.
It's right there.
Yeah.
That's what happened. When interest rates went up, we saw it, right? And then we had, interest rates come back down, real estate continued to rise. So we kind of know the playbook. And then, so when that happens, does real estate flatten up? But those sitting on the sidelines, I'd be pretty concerned. What's the plan? Real estate's probably not coming down as it reaches new highs. Will it go? So if you wait until interest rates go up, you buy that house for the same price, except your mortgage costs you twice as much.
Right.
And that doesn't make a whole heck of a lot of sense. Again, why there's so many buyers in the market. I think realtors are doing a good job getting this information out to clients, saying sitting back and waiting is just going to cost you more money in the future.
Right.
And so I'd love to continue on this dialogue and talk to you about why interest rates will go up, because it's not the Fed that's making that decision. It's mostly China and inflation economics. But I think we'll have to come back to that perhaps.
Right. But basically, you're talking about changing a whole new world order, and that's kind of a black swan event.
Yeah. Black swan event where real estate goes flat. It's not 2008, people. Okay. Well, let's talk about some actually bigger headwinds that we're looking into, right? And something that could actually have an effect on real estate prices as well, that we didn't touch on. But we have taxes that are going to be higher in the future. And there's a lot of posturing right now, and Biden is coming out just about every other day talking about his $1.8 trillion spending bill that's largely meant to extend cash payments to parents, to institute universal pre-K, right, and free community college, right, in addition to other things. So $1.8 trillion spending plan, where's that money going to come from, right? Well, assets, liabilities, income, expenses, right? ALI, we always talk about the four variables in finance. So we're going to spend more. Well, we have to have more income. So where are we going to provide that? We can either take more liabilities, which is what we do, continue borrowing money, or we have to raise income. And what is income for the government? Taxes. That's it, right? So Biden can't get this through without a tax increase, and he's vowed to say that individuals or households making less than $400,000 won't see an increase in their taxes. And currently, it looks like if you're married filing jointly, you're at the $509,300 mark, right, for taxable income. You're going to see your top bracket go from 37 to 39.6. Single filers, 452,700 is when their top bracket. So okay. So a 2.6% move in the top bracket for those making roughly $500,000 or more. Okay, no big deal, perhaps, right? I mean, there'll be some him and hawing, no question, but not a big deal, I don't think. Nothing that's moving the markets.
Not right now.
But the big issue is this capital gains rate proposal, right? The capital gains rate proposal now looking at for those who earn $1 million or more, and that's just for that year. So if you sold a property or sold a business or had a big, IRA distribution, investment income in addition to your other income, and you somehow got over that $1 million, you're now paying a 39.6% rate on all of your dividends and all of your capital gains, right? So long-term.
That's up from what?
From 20, right? So double. And then you add in the 3.8% Medicare tax we have on net investment income earners, which is around 250 to 300 is when they start having to pay, or 200 to 250 is when they start having to pay. So you add that up and you get a whopping 43.4% federal tax rate on long-term capital gains and dividends. Now, us taxpayers in California at the $1 million mark above that are paying 12.3. And this is where the math gets really concerning, and it's going to fire up some people. They're looking at a 55.7% combined tax rate on long-term capital gains. 55.7. You're keeping 44.3% of your gain once you get over that $1 million mark. And I don't know, the optics of paying more than half of the income in taxes, I think, is a sticking point for a lot of people.
It will be. Effectively, why take risk? And that's just going to be the question from innovators, from people who are creating and taking risks. They're going to ask themselves, why am I taking risks? Why am I putting in productive capacity in my life or my capital? And I'll just find another place to do it where it's just a better sandbox to play in.
Yeah.
Right?
Yeah.
I mean, I think Tim Draper was on, and obviously he has his opinions, but he really went into that. He's a big Silicon Valley buff and just really talked about how taxing innovation is a long-term challenge, and that capital will find its way to be more productive.
Yeah.
So we'll see really where it comes. I heard an interesting comment of effectively calling out the $1 million above income is really the beginning of potentially starting to create a new tax bracket.
Right.
Really kind of moving back into a lot of 60s type politics. We've talked about that a lot here in the last 6 months about the rhymes with what's going on today with the early 60s. So that could be potentially too what's happening. But either way, how many times in the last 12 months have you seen somebody's financial plan and they've said, I can't sell those stocks. I've got all these capital gains. I don't want to take these capital gains. So
right.
What do you do now?
Right, because that rate's going to double.
Yeah.
And believe me, I'm having that conversation on a daily basis. I was talking to an individual yesterday who's selling real estate and businesses that have to be done this year.
That's right.
I mean, to wait till next year, you're likely going to pay double. As painful as that tax bite might be. So we always tell people, stop pretending like inflation, taxes, and market crashes don't exist. We know, especially with taxes, you're given a heads up, everybody. We know that the tax rates are going to be higher, right? We know that. What they're going to be, I'm not sure, but we know they're going to be higher. If you're over the $400,000 mark, you're likely going to see an increase in ordinary income taxes. If you have over $1 million of capital gains, you're going to be heavily, heavily penalized, or $1 million of income. And so tax planning in 2021 is going to be very, very important for those individuals, wherever it might end up. And, so taxes are going higher. The one negotiation point that I think is going to be interesting that I'm watching to see how this unfolds is because, it's a really tight split in the Senate. Right? And so I don't think Biden can really afford to lose any Democratic votes on his side in both the Senate and the House. And where are the majority of congressional Democrats is in California and New York. And the one thing that they all want, that we all want, is in California is we want the assault tax elimination to be repealed, and for us to once again be able to deduct property taxes and income taxes and state income taxes without limitation.
Right. And
especially so once we look at this new tax policy, right? Can you imagine paying taxes on your taxes at 55.7%? And so that is a very hot button for congressional Democrats, especially from the hubs of California, New York, Massachusetts, right? And so they're saying, look, we're not going to sign anything without that. Well, that's going to decrease tax revenue when they bring that back. So that's going to put more pressure on Biden. And from what I can tell, he hasn't proposed anything of getting rid of that elimination. So there's still a fight, right? So we'll see. So, maybe this is posturing, but one thing that we know is that taxes are going higher, and our deficit is going higher as well, right? If you want to bring tax chart 2 up, Sierra, let's just look at this real quick, and we'll move on. But, I mean, so, Luke, you, on the bottom here, you have the top highest bracket for U.S. individual income tax, ordinary income tax, okay? So here it is. We've seen it up almost like 90%, right, in the 40s, 50s, 60s, and started to go down. And then a big decrease in the Reagan era, right, where ordinary income taxes have come down and really stayed low since 1980. Right? And so what happened at that exact same point, if we look above, well, this is our U.S. Surplus or deficit, annual surplus or deficit. So taxes go lower, and almost instantaneously, right, we just start borrowing more and more money because we didn't cut back spending, we just cut back our income. And so when you spend more than you make, you have to take on debt, right? So individual households, that's exactly what you have to do. If you're a government or a corporation, that's what you have to do. So here we are. We're borrowing. And at some point, we're going to have to start either cutting expenses, which no, we're adding a $1.8 trillion spending plan. So even just to keep our deficit, we have to raise, and I think so far we're hoping for like 800 trillion of the 1.8 trillion we're planning to spend. So it's still increasing the deficit. So anyway, that's all that is to say that the numbers would suggest that we're going to have very little chance of escaping an increase in taxation in the years ahead.
So that brings a really good segue into why, right? So into our next segue, which is really kind of market activity, sell in May and go away in a way. So before we get into sell in May and go away, let's just talk about why are we doing this? Why is the government doing what they're doing? Why do we have rates so low? What's the whole point? And if you really want to, let's try to simplify it just a little bit. They want inflation. Like just hands down.
Right.
They want inflation.
Yeah.
And specifically, the mandate is full employment and inflation.
Yeah.
And so we just had numbers out today. Jobless claims, I won't go through the data. They're still too high. Let's just put it that way. They're still too high. They're 2x what they would have been in a normal environment. So we still don't have people employed. And since 2008, we haven't had great inflation, and inflation expectations have been really low for more than a decade. That's a problem for a lot of people who are looking for income growth. And really, what are we trying to do? It's not that we just want inflation to inflate assets and destroy people's, values. They really want to create income growth, because income growth is going to create higher spending, higher GDP, and it creates that whole invisible hand. So really what it's all about is, let's get these rates low. Let's create inflation that flows through to higher incomes for people so they can afford higher mortgages someday. Because rates are going to go up someday.
Yeah.
They're not going to stay low forever. And if we can get higher incomes, we can afford higher payments.
Yeah. And I would say that they probably are maybe very interested, if not mostly interested, in destroying asset prices as well. So if you think of the asset on the balance sheet as a liability to them, right? Yeah. So it's China's asset.
Yeah.
China borrowed the money, or we lent us the money, right? So we borrowed the money, so they have the asset, we have the liability. You cause inflation, and we make that liability for us worth nothing, which makes their asset worth nothing. So I think inflation is like the name of the game of why we're running this deficit and borrowing the money, because we're saying it's not going to be worth anything when we pay it back. Kind of like what we tell people about a 30-year mortgage. Right? It's the same plan. It's good economics. I want to get back into this market, but let's just talk about this sell in May and go away nonsense for a second, okay? Because I usually, as over my 16-year career, I got to hear this a couple of times every May, and we just have to spend a little second on it, right? So look, if you don't know, you've heard this theory, and you're going to see headlines, out there of sell in May and go away, and what is that? So some brainiacs did a study, right, and they said, hey, the months from May through October, since 1945, the S&P's returned, roughly 2%, where the other 6 months of the year, it's been over 6% average, right? If you look at since 1990, it's 3%, in the May through October, and 7% plus on the other months. And that's an average, right? And so that's where they're like, sell in May and go away, which first of all, it's like, what, you don't like 2 or 3% on your money? Like, what? Like, I'll take it. But look, let's just come back to look in the last 5 years, right? And so I charted out the S&P from May 1st through October 31st, right? That's sell in May and go away theory. So in 2016, you gave up 4.9% return on the S&P. This does not include dividends, by the way. 9.8% in 2017, 2% in 2018. Which, by the way, in 2018, you came right back into a market slide, right? So you would have missed the 2% and then saw your capital decrease by another 10 or 15. 2019, 14.1%. And then last year, a whopping 19%, right, if you were to sell in May and go away. So the numbers certainly suggest that we shouldn't do that.
No, I don't think so. Unless you're running some sort of some performance-based hedge fund, and you'd like to book your fee and just move on and go to the beach.
Yeah,
I don't think it's a great plan.
No,
at all.
No. So let's not liquidate our stock portfolios because of the position of the sun in the sky. Maybe look to some other things, and look. I mean, if you aren't long term with some things in your portfolio, you have some tactical positions or moves. Maybe May is a good time to assess whether you're long term, and maybe make some rebalancing opportunities. But we're not getting out. So anyway, we have. Talking about taxes, we're talking about inflation, we're talking about interest rates going up potentially. These all could be headwinds in a case for the market to capitulate.
Sure. I mean, and let's just look at them all as a step function right now. Right? We can't forecast whether we're going to continue to see these. I don't know if I'm going to predict that lumber prices or copper or hog prices or you name it are going to have another step function next year, which would create inflation. And the message that we're getting from the data and the message we're getting from basically the maestro of our economy is saying that we have had a rebound, and the rebound is actually going really well, but we're not recovered.
Yeah.
So rebound, not a recovery, it's a really good way to think about where we're at. And if you're not in the market, you're probably nervous, right? Because you've missed out on a lot of activity over the last year. And probably thinking, just
hoping for COVID-21.
Yeah, thinking things are going to come back down.
Yeah.
But I think that message is really simple, that a rebound is not a recovery.
I love that.
Right?
I've heard you say that before, and that's, I think, really helpful for people to know.
Cool. And so what number would you think of being recovered? I would think of 200,000 weekly jobless claims. I would think of an unemployment rate back to 3-4%. We're at 6 now. We're still having weekly jobless claims of 500,000. And continuing claims, we'd want those to 1.6 million versus 3. So we're getting there week over week, month over month. We're getting better. But those last positions of getting people employed and getting these jobless claims to go away, right? Getting them into the economy, getting that invisible hand moving, it takes a long time. It does. So rebound is great. I think the other thing that has really caught my attention, especially today with all this earnings season going on, is that we have growth, tech, let's say work from home type stocks that had this huge activity, huge boost to their revenue last year, right? Like, I'm going to stay home and ride my exercise bike every day. Well, maybe I'm going to go to the gym now. I don't know. So those stocks are having more difficult challenges as they report their earnings, while someone who's doing HVAC equipment or construction is booming because we've seen economic stimulus and economic boosts that are highest in 35 years, PMI indices. So as earnings seasons are coming out, obviously people are having difficult comps from last year or having easy comparisons as we reopen. So how's that going to look in 1 year? 1 year from now, tech companies who had difficult comparisons this year are going to have easier comparisons next year.
Right.
People who are having huge boosts to their business from reopening, GDP cyclical growth, they're going to say the exact. They're going to have the exact opposite. I could already hear the conference calls rutting in there, like, that reopening in 2021 was just so significant. We just can't comp against a 65 PMI.
Yeah.
So that makes asset allocation pretty challenging right now because it would be really fun.
Well, I think it makes it pretty important.
Super important.
Right.
Super important. And you could just run everything that's working right now, right? You could just take all your assets and say, I'm going to buy everything that's inflation sensitive and cyclically sensitive and anything that's going to go up if the 10-year go up.
Right.
And in 1 year from now, that would be selling all your tech stocks, long-term duration, kind of growth type securities. And in 1 year, that may not work at all. And so you have to have a dance here and think about what risks work for you and your plan and how to properly allocate your assets as this economy is legitimately going to like flip back and forth over the next
multiple
12
rotations.
to 18 months.
Yeah, that makes a lot of sense.
So, I don't know. I think that's that.
So some good days ahead, we think. So the selling may go away. We kind of hopefully debunk that myth, hopefully debunk the real estate bubble. So always look at your plan, make sure you have a good asset allocation that fits your plan for the long term. You work with your wealth managers, financial planners to detail out when you're going to need the money, and where is it going to come from. That's going to help dictate your asset allocation. Interest rates are really cheap, making housing really affordable. We don't see any bubble being created just yet in the real estate market. So, if you can afford it, look at your long-term plan. And a home is where you live. It's where you spend your life. Money's not real. It's a means to an end. So enjoy your life and make sure that it's something you can't afford. But, don't just do things to die with more money. But in the end of the day, do anything to stop giving the government more money than they need. So do some tax planning, even if it's just to die with more money. So I think that's my wrap up for the show today. So yeah, Luke, it was fun. Look forward to coming back with you guys in 2 weeks for the Presidio Perspective Financial Podcast. I'm Dustin TenBroeck.
And I'm Luke Jacobson. Thanks for joining us today.
You guys have a nice weekend. We'll see you next time.